I think 4,000 is about the support. Even though we're below it, it's like 3,000 was support. When we first broke above 3,000, we had several trips back down to 2,900, and then we took off for good. And I think we're doing now around 4,000 what we did earlier at 3,000.
Jeffries is saying 6,600. They used to be a primary distributor for all the major mints. They know gold. And then you look at Goldman Sachs that is saying $5,000 gold.
In this powerful market discussion, Peter Schiff and Andy Schectman share their insights into the current gold landscape and what could come next. The conversation centers on the idea that the $4,000 level may now serve as a major support zone, much like $3,000 did in previous cycles before gold's last big rally. The analysis suggests that when gold first broke above $3,000, it frequently revisited $2,900 before launching into a sustained move higher. Now, a similar pattern appears to be developing around $4,000, with consolidation possibly setting the stage for another surge. According to market reports, Jeffries projects gold could climb to $6,600, while Goldman Sachs maintains a bullish outlook of around $5,000 per ounce. This conversation explores more than price targets. It digs into long-term fundamentals, investor sentiment, and the ongoing global shift toward tangible assets. Whether you're a seasoned investor or simply tracking the next potential breakout, this analysis provides valuable perspective on why many believe gold's strongest run might still be ahead. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on gold, silver, and the markets.
On top of 39% lease rates in London, you got to cover a position, yeah, it's only 39%. Or 19% borrowing fee for SLV, really, 19%. Or record deliveries in COMEX, or record shortages on the LBMA, or lines all over the place in Singapore, or outages at the biggest refineries in India, or massive outages in retail silver in China. I don't care what you look at. The Chinese flying all over the world buying doré and concentrate. If you don't see the bigger picture right now, you're missing what is a generational opportunity, but it will not go straight linear higher because you have some of the world's biggest banks on the planet who are massively short, who are now getting margin called and can't borrow the silver unless they want to pony up 39 or 19%. SLV, which is so stupid and is run by JP Morgan and BlackRock, you can naked short it. So in order to get those shares back that you shorted, to buy them back, you're going to pay a massive fee. No one wants to sell them or to borrow them to you. Anyways, the bottom line is that what we saw Friday, the demand has overwhelmed it again. And that's what's different. In years past, the neck would have been broken and we never would have seen these numbers again. And here we are today, and it's right back almost exactly where we were on Friday. That the managed money is short notionally $1 billion of silver. And when the managed money is short, guess who takes the other side of that? Well, that's right. It's the commercial banks. They're the ones who know the playbook. They're the ones who finance everything. So if the commercial banks go long and the managed money is nearly record short, how do you think this ends up in the next few weeks? It's called squeeze. It's called margin calls. It's called, if I had a gun to my head, silver goes much higher very soon here as that managed money position starts to unwind. It's going to happen. The bullish technicals on every metric, from just flat out technical analysis to the distortions on all the delivery mechanisms, the LBMA, all of the things that China and the BRICS are doing, and Saudi Arabia and Russia and India, and now the U.S. calling it a critical mineral. And gold, I mean, gold is going to back the system. It's going to back a common trade settlement system in the BRICS nations. It's going to back the treasury market, I believe, and Judy Shelton certainly does keep saying it here. Things are changing, and the prices are going to go higher. Get used to volatility. $100 is only 3%. And when you talk about the potential for some sort of a delivery distortion on the LBMA, it's real. They have 140 million ounces of free float, of which they're trading 600 million ounces a day. There's 2 billion contracts, 2 billion ounces in contracts that are out there that could stand for delivery against 140 million ounces. Now, what could possibly go wrong?
More investors are waking up to the reality that, gold has outperformed stocks for the past 25 years. That the thesis behind gold, the investment thesis, is stronger than ever. Central banks are committed buyers. They're de-dollarizing. They're moving off the dollar standard back to the gold standard. They're going to keep buying gold. Institutions have finally discovered gold. So it's a great story. And the gold mining companies, gold's not going back down below 3,000. It's not going to get much below 4,000. But even if you think it could fall to 3,000, 3,000 is a great price for these mining companies because their cost of gold maybe $1,400, $1,500 an ounce. That's huge profit margin. There's very few businesses that have margins that high. And that's with the price of gold falling. But what if the price of gold just keeps rising? The problem for a while for the miners was that even though the price of gold was rising, the cost of mining it was rising faster. Now, it's the opposite. Gold prices are rising much faster than production costs. And so these companies are going to be making a fortune. And that also means a lot of these companies are going to get bought up because the big companies are cash machines now. And what they're going to be looking for is how do we replace our reserves that we're mining? We can either launch some exploration projects and roll the dice, or just buy up some reserves from some of these cheap companies that they're publicly traded. We could just buy them up. And that's what's going to happen.
In this high-impact discussion, Peter Schiff and Andy Schectman break down what could be one of the most critical turning points in the global metals market. With silver lease rates in London hitting 39%, record deliveries on COMEX, and massive shortages across the LBMA and global refineries, the setup for a historic squeeze is building. Commercial banks are going long, while managed money remains heavily short. A combination that often precedes powerful upside moves. As BRICS nations push toward a gold-backed trade system and the U.S. now labels silver a critical mineral, the landscape is shifting fast. Central banks continue to de-dollarize. Institutions are accumulating gold, and mining companies are poised for record profits as margins widen between spot prices and production costs. This analysis exposes the growing disconnect between paper silver contracts and physical availability, a distortion that could ignite extreme volatility in both metals. With fundamentals aligning and market pressures intensifying, the next few weeks may redefine the value of tangible wealth. Let's get into the interview.
Gold is above 3,900. A month ago, that's an all-time record high, right? A few months ago, if you'd have told anybody that gold would be at 3,900 and change in November, they'd have been, no way, it's not going to get up that high. All we did is we went a little bit too far, too fast. Gold got extended up to almost 4,400 and then had a sharp couple of day pullback. But gold is in a powerful uptrend. This is a massive bull market. And it's classic that you have this sharp decline. Almost all of the decline was one day, right? We had a 6.5% drop in a single day. It's gone down a little bit since then, but that was the lion's share of it. And it scared people because the ETF buyers are not diehard Bitcoin maxis. I mean, after all, if they were, they wouldn't own ETFs. They'd own their own Bitcoin. These are just traders or regular investors who bought these ETFs because they were going up and because they were hyped and promoted, and people thought, hey, I'll buy this and I'll make some money. Well, when they see that they're down 20, 30, 40, 50%, people are going to say, I had enough. I'm going to cut my losses and I'm going to move my chips to something else. Well, I think that that's going to happen en masse. I think you're going to see, a year worth of buys liquidated over 1 or 2 days. And the question is, who is going to buy all that Bitcoin? We know who sold them all the Bitcoin. Those are all the whales, the OGs that had all the Bitcoin to cash out. But who's going to step up to the plate and buy that Bitcoin? And by the way, if you go back and look at a lot of the big Bitcoin crashes, all of a sudden there's a bunch of new tethers that come out of nowhere and buy up Bitcoin, right? And people are like, wow, they just counterfeiting these tethers and using tether kind of like the Fed, like to prop up the market. Well, when the ETFs sell, you can't buy with tether because the ETFs can't stick tether into the brokerage account of their customers. So they're going to have real dollars. So you're going to have actual buyers, not fake tether buyers, but real people are going to have to step up and catch that falling knife and say, oh, I'll buy that Bitcoin. I don't think they exist. Maybe there'll be some pressure by the Bitcoin community on Trump to get the U.S. government to bail out Bitcoin, right? To fill up the strategic reserve. But that would be real desperation if taxpayers had to come and bail out Bitcoin, especially when Trump's family is completely invested. It'd like to be a bailout for his own family to use taxpayer money to buy up, Bitcoin. But it would also, the fact that the government needs to bail out Bitcoin proves that the whole thing is BS. It's not a strategic asset. It's not digital gold.
As gold trades above $3,900, the market is witnessing a historic transition from speculation to tangible value. Peter Schiff and Andy Schectman discuss how the recent pullback from $4,400 is nothing more than a healthy correction in an ongoing bull market that continues to gain strength. While many short-term traders were shaken by a sharp one-day drop, long-term fundamentals remain firmly bullish for precious metals. At the same time, questions are emerging around Bitcoin's resilience. With ETF holders facing major losses and Tether liquidity under scrutiny, capital may soon rotate out of digital assets and into real stores of wealth, gold and silver. Unlike crypto markets propped up by synthetic leverage, the metals sector is backed by physical demand, tightening supply chains, and growing institutional adoption. As the global economy pivots toward hard assets and BRICS nations push for a gold-linked system, investors are beginning to understand where true value lies. Volatility is part of every major trend, but the direction of real money is clear. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on gold, silver, and the markets.